What if you built a hedge fund with a dream team of the smartest financial minds on the planet? Not just brilliant traders, but two Nobel Prize-winning economists. For a while, their firm, Long-Term Capital Management, was an unstoppable money-printing machine. But then, in just a few weeks in 1998, their genius was proven spectacularly wrong. Their model shattered. They lost $4.6 billion, and they came terrifyingly close to triggering a meltdown of the entire global economy. Long-Term Capital Management, or LTCM, was founded in 1994 by John Meriwether, a legendary trader from Salomon Brothers. He wanted an intellectual powerhouse, so he recruited academic superstars Myron Scholes and Robert C. Merton. In 1997, they shared the Nobel Prize in Economics for their groundbreaking work on options pricing. They were joined by other top minds, including a former vice chairman of the Federal Reserve. When their doors opened, investors lined up, believing a team this brilliant couldn't possibly fail. LTCM's core strategy was called Convergence Arbitrage. A classic example was their trades with government bonds. The most recently issued U.S. Treasury bond, known as an on-the-run bond, is highly liquid and trades at a slight premium. A slightly older bond of the same maturity, an off-the-run bond, is almost identical but less liquid, making it a little cheaper. LTCM would bet this tiny price gap would close. They would short the expensive on-the-run bond and buy the cheaper off-the-run bond, planning to pocket the difference when the prices inevitably converged. The catch: these profits were minuscule. To turn them into the massive returns investors expected, LTCM used extreme leverage. For every $1 of their own capital, they borrowed over $25. At its peak, the fund had about $4.7 billion in capital, but controlled over $125 billion in assets, with its off-balance sheet positions having a notional value of over $1 trillion. For a few years, the machine worked perfectly, posting incredible annual returns of over 40%. The partners thought they had cracked the market's code. The downfall of LTCM can be summed up in one word: hubris. The partners had an almost religious faith in their models, which were built on historical data. They assumed markets would always be logical and liquid, meaning they could sell their assets anytime. But in August 1998, the unthinkable happened. Russia devalued its currency and defaulted on its debt. This triggered a global panic, a massive flight to quality. Terrified investors everywhere dumped risky assets and flooded into the safest investments possible, like U.S. Treasury bonds. Pure fear took over, the one variable their genius models hadn't properly accounted for. This flight to quality was an absolute disaster. The fund's entire strategy was based on price gaps closing, but in the panic, they widened dramatically. Investors paid an even larger premium for the most liquid treasuries, causing the spread to widen dramatically and inflicting massive losses. Almost every single one of their trades was going against them, all at once. Their massive leverage amplified every loss with terrifying speed. On a single day in August 1998, the fund lost over $500 million. Making matters worse, their assumption of liquid markets evaporated. Everyone was trying to sell the same assets the fund owned, and nobody wanted to buy. They were trapped. Lenders started making margin calls. Within weeks, the dream was over. By late September, they had lost a staggering $4.6 billion. The unstoppable machine had crashed. The situation was so dire that the Federal Reserve Bank of New York had to intervene. On September 23, 1998, the Fed brokered a private rescue package, not a taxpayer bailout. The heads of 14 of Wall Street's biggest banks were effectively told they had to save their client to save themselves. Reluctantly, the banks cobbled together $3.625 billion. In exchange, they took control of 90% of the firm, effectively wiping out the original partners' control and much of their wealth. The geniuses had failed. LTCM's strategy was famously described as picking up nickels in front of a steamroller. For years, they pocketed the nickels, but when the market steamroller finally caught up, it flattened them.